So I'll give a quick background on myself. Name's Imran, part of the DeFi Alliance, which is actually Chicago-based. Its core focus is trading and providing liquidity for DeFi startups. So we work with firms like Jump Trading, Cumberland, and some of the other larger market makers. And the core goal is for us to bring liquidity to DeFi protocols. Early around 2019, when DeFi protocols just started to launch, one of the core things that they were looking for is institutional adoption. So that is liquidity, then also like product feedback. Most of the trading firms that are ultimately going to be users of these products are looking for things that they can play with, that they are more comfortable with. And so part of our program, we offer product feedback and then ultimately regulatory support. Obviously, we're building for a new world, and in this case, a lot of the regulations hasn't caught up yet to what we're doing. And so we have a regulatory task force that kind of leads the way in terms of how the regulatory framework should be. But that's the high level of the DeFi Alliance. I'll pass it over to Nate, and then we'll go from there.
Hey everyone, my name's Nate. Work for Cumberland. So Cumberland is a large OTC desk primarily. Beyond that, we also do prop trading, VC investing, proud members of the DeFi Alliance, and really looking forward to chatting with you all. For a little bit more background, Cumberland's a part of DRW, which is a large Chicago-based kind of prop trading firm. We're in pretty much all markets. So we have Cumberland, the crypto arm, we have a real estate arm, a VC arm, and then desks for equities, options, futures, commodities, FX, you name it, we probably trade it. Yeah.
My name's Chal, one of the partners at the DeFi Alliance alongside Imran. It's actually the first time I see Imran since COVID. So it's very nice, good to see everybody. Focus more on the, I guess, investment, deal sourcing, due diligence side of things.
I'm Seth, in from New York, from CoinFund. We're investors on the venture side, liquid side, proud members as well of the DeFi Alliance. So happy to be here.
Cool. So we're going to look at you guys now and see if you guys have any questions. Topic is open games, so anything in DeFi, Web3, Polkadot, you name it. So I'll give it a minute. There you go.
Go ahead. So this one's for Seth. I'm curious at CoinFund, which, if there's a specific category within DeFi that you guys think is kind of the most exciting, kind of where you're finding opportunities right now.
Yeah, I mean we're really non-dogmatic in what we're looking at. We take the view that we have. So on the liquid side, we have 9 to 12 months of visibility. On the venture side, we take a longer term view, but also have the ability to course correct if we see things developing in a way that is unexpected. I think cross-chain interoperability, really interesting dynamics. What we're seeing with the Polkadot ecosystem really starting to come to fruition. We are investors in Akala, investors in Moonbeam, investors in Polkadot and Kusama themselves. So very, very excited to see the Polkadot ecosystem really come to fruition. Yeah.
Tori.
I got a left field one because the only other thing that really exploded since DeFi summer was like NFT fall or winter or whatever. Do you guys think that there's an overlap between the NFT trend and the DeFi trend? And if so, are there any interesting projects that seem to be building at that intersection, either through representation of real world assets that then get used within DeFi systems, or anything related to using NFTs as collateral? Is there an overlap, or am I asking just a really weird, narrow question that's kind of missing?
I can start off with this one and try my best. It's definitely a tough one. So overlap between kind of DeFi and NFTs, there's a number of ways. I think NFT kind of is more frequently attributed to art, which is not the only use case. So Uniswap v3 is probably the most common use of an NFT in a non-art format. And basically, NFTs are good for any asset that's not homogeneous. So If something needs to be differentiated from kind of either other forms of the asset, if it's kind of a loan agreement or something with nuanced terms, or in the case of Uniswap, where it's kind of it represents your liquidity providing position, there's a number of kind of options there. Beyond Uniswap v3, I know Aave is kind of exploring NFTs as collateral, as well as Maker is using NFTs to tokenize real-world assets. So they're basically working with Fortunify and Centrifuge. Initially, Fortunify is using this thing called revenue financing bonds, which are basically this really niche financial product where you can lend money. Typically, it's with SaaS businesses and say, like, hey, you don't want to sell equity and you don't want debt, so we're going to give you a percentage of our revenues for 2 years and you give us financing up front. And this is actually a really good use case for Maker specifically because it's a debt product. And you can basically use the cash flows from the revenue to pay it off over time. And so Maker specifically kind of has initially a 5 million DAI debt ceiling for real world assets, but they have a governance appointed risk and real world asset team that manages the onboarding. And because it kind of bridges these like non-crypto native, non-homogeneous assets, they kind of need a different liquidation process. So I believe you have to sign an MLA, a loan agreement, and any kind of liquidation proceedings go through normal courts and have like a 2 to 3 month period to initiate that. And so I think NFTs are, quite interesting in the art space. In the user engagement space, there's a lot there where they're not so effective as making users that don't care about your product start caring about it. I think there's some funneling that can be done there, but primarily it's good for like further engaging your already kind of super user most engaged client base. And then beyond that, it's just tokenized representations of things that are not homogeneous. So something like a loan agreement is a perfect example where each one has a different term, and so it's easy to differentiate it.
And then you can build that into structured products with multiple loans. And we're investors in an DeFi, which is doing financing using NFTs as collateral. Upshot, a protocol for valuing collectibles. Lots of innovation that's kind of at the intersection of NFTs and DeFi.
Imran, you led this off by talking about institutional adoption, regulation. The two seem to go hand in hand in many regards. So 2 questions. What are you hearing from regulators broadly about DeFi? and then what do you think about some protocols being kind of proactive, such as Aave offering
Aave Pro.
a permissions pool? Is that something that you think is going to work and expect to see more in the future? Just would love to kind of hear your thoughts there.
Yeah, from the regulatory standpoint, there's a lot of background wars that are going on between just like folks that are representing DeFi and kind of like, folks in the legislation side. The stance is from their side is that they want to regulate every single entity that's out there that is a known smart contract or a VASP. And the reasoning for that is because these VASPs could ultimately engage in things that could be harmful for the government. And so the way we see it is it's just more of a learning and education curve that's going to take some time. And that's just like a battle that's going to be kind of ongoing. But the good thing about it, and a lot of this is nuanced in terms of politics, there are some folks that just started to take the helm of the SEC and other kind of government agencies. And it's really just having to educate and just kind of getting them on board with what's happening. But it's going to be a longer term battle. And it's just going to be something that it's just going to be a work in progress. Now, in regards to Aave Pro, I think the way they see this landscape right now is the fact that if they come out and start to just adhere to the current regulatory framework, then they could get some good, kind of like goodwill from the regulators. So they want to take their best step forward by offering permission pools on Aave with the KYC AML process. There are other firms that are doing this, like Uniswap is going to be doing this as well. This is kind of like not public, and other DeFi protocols. And there's a certain strategy behind that. And so the way we kind of see it is, there are going to be DeFi protocols that are going to be focused on regulated markets, and there are going to be DeFi protocols that are just going to be anon-led, mostly anon-led, that are just going to focus on the Web3 world. And so that's kind of the two roles that we see.
I'll also add with the institutional side. So in terms of these permission pools, I think kind of the initial use case is more akin to like a sandbox for institutions to get involved with DeFi in an area that's like comfortable for them. Over time, I think the next step is going to be permission pools where it's not just institutions, and if they're issued by kind of decentralized protocols like Aave, for example, you'll probably start to see something where you have basic features like over-collateralized borrowing in these non-permission pools. And in the permission pools, you'll start to get access to more features that require kind of knowing your identity. Whether that's integrations with some sort of like credit reporting agency and allowing you to kind of act as a known agent, borrow under collateralized or something of that nature. But I think over time, so what you're seeing initially is like this bifurcated market where you have institutional only whitelisted pools and then kind of retail plus institutions that are comfortable with it, permissionless pools. And you'll start to see that kind of change to more of a gradient where there's the farther into the centralized world you want to go, the more kind of features that you're used to in traditional like financial platforms that you'll be able to get. This may change over time, like to focus on borrowing and lending because it's a really easy one to kind of explain. The only reason that credit scores work is because there's recourse, right? And it's really hard to just come out and say like, hey, I'm gonna build recourse into DeFi because you can just spin up a new wallet or link it to your identity. But maybe you can borrow enough money that it doesn't matter that you burn your wallet identity, but you still have like your normal credit score. And so I think over time, you'll probably start to see something within crypto, maybe not necessarily only native to crypto, but where there's kind of enough on the line and you're giving enough up that there is sufficient recourse. And then you can start to see things like under collateralized borrowing and lending, but it's something that's gonna take a long time to build out because you can't really create a system with recourse overnight. It's very difficult.
And there are projects that are out there that are working on credit scores, and that's just kind of analyzing your wallet history or transaction history and assigning some sort of like score that's kind of whitelisted within some DeFi protocols that allow you to have like under collateralized loans. There's projects like Spectral. I think there's a couple others that are out there. Union, I think, is another one as well. If you build on substrate only, but if you're wanting to leverage the Kosama's validator set and their overall security module, then you want to build on Kosama, and then you don't have to worry about recruiting your own validators. What's up, Matt?
Since like the start of 2020, like pretty much every DeFi metric has, precipitous exponential growth, right? A couple of which are like, the unique addresses that interact with DeFi, which is up like 13, 14x year over year. And then even like the Uniswap pairs that have come online up like 35x year over year. So kind of like going forward, I feel like it's going to be a little more difficult for these DeFi protocols to compete with one another. But for you guys, what do you guys see as being like the core differentiators for protocols in DeFi going forward?
That's a tough one.
Could you repeat the question?
It's honestly like one of my shower thoughts.
My thesis is ultimately all the DeFi protocols will be competing with I shouldn't say protocols because protocols implies backend, but all the DeFi products will ultimately compete with each other in the long run. Everyone will go horizontal. So for instance, if you start as a derivative exchange and you dominate this niche of derivatives trading, you're going to use your existing user base as a distribution channel to build other products and distribute those products. So for instance, you can get into like spot trading and compete with Uniswap. You can get into lending and compete with Compound. I think that's going to happen in a few years. But I think projects shouldn't do is start building a spot exchange with some very incremental innovations and compete with Uniswap. I don't think that's going to work. There's no way to differentiate yourself just by building a spot exchange with like little features here and there. I think it's too tough. But right now there are a few sectors that don't have any like clear front runners, like derivatives, under collateralized lending, or fixed income in general. I think we're going to see a few winners maybe this year, maybe in the next couple of years, that will dominate these two sectors, and eventually they're going to compete with others on the front end. But back end might be different. So back end things might, like, by front end I mean like the user interface that users see and use, right? Like they're going to compete with each other. But back end is like protocols, is code, is the code that executes. I think we might see things that ossify over time. So we're going to see a huge fragmentation of protocols on the back end. And they're not really trying to compete with each other. They're just going to ossify over time and drive a lot of liquidity into their own protocol. So I don't see really that back end becoming super competitive, but the front end will be super competitive.
I think another interesting dynamic is, what we've seen in DeFi over the last 18 months has been kind of the organic, like non-regulatory guardrail competition, and how that led to different axes of competitive strengths and different flows of capital. I think as you get those regulatory guardrails coming into place, as you get traditional institutions that are more comfortable engaging with DeFi, you're going to start to see business development decisions from traditional financial companies actually drive adoption and drive capital flows in a way that could massively overwhelm the way that organic flows work. And so you could end up with some very unexpected outcomes that are a result of, just the first thing that comes to mind, you look at like Coinbase wallet right now. I don't think they have like that much activity on their one-click trading, but like it makes a big difference if they're routing that through 1inch or if they're going directly through Uniswap, right? And like they were doing 1inch for a while, now they're doing Uniswap. But you think about, like, imagine if they start doing massive BD and they're getting real volumes coming in, and then they're like, oh, we struck this great deal with Balancer, and we're going to go with Balancer. Like, they can drive massive volumes in a way that could overwhelm kind of the organic development that we've been seeing in the space. So it's going to be interesting to watch.
And also add that, like, the dynamics are changing, quite frequently. So like Uniswap was at one point competing with SushiSwap, but I don't see that competition happening any longer because Uniswap essentially, their new variant allows you to mimic any type of pricing curve, which is pretty cool. So if SushiSwap wanted to build on Uniswap, theoretically you could do that today and it'll just mimic SushiSwap's pricing curve. Now they've ultimately went down a layer, and now they're wanting other protocols or other AMMs and DEXs to build on top of Uniswap versus having to source liquidity themselves. So the dynamics are changing on the back end, I'd say, as what Chao said. On the front end, there is some high-level competition happening, which is starting to consolidate. So like Matcha is an example, and some of the other front ends like 1inch. And they're like highly competitive. It's all about customer acquisition strategies, how do you retention, and then along with that, user experience. And that's one of the areas that's kind of lacking in DeFi today. It's just how do you get your average retail user to like understand, open up a wallet, place a trade, and be able to execute as seamlessly as Coinbase. So we're going to start to see consolidation in that area, and we're going to see like a few winners, I think, emerge over time.
And one other point to go back to what Chao said about kind of horizontal integration of protocols. So Uniswap has made it like very difficult to compete because they've basically licensed or patented their product and are not licensing it out, at least yet. And so SushiSwap has kind of gone a different route and saying, well, it's really hard, if not impossible, for us to compete in terms of like capital efficiency. We're going to go horizontal and add all these other product features. And they may actually at some point kind of say, like, why would we compete on the AMM space when we can just kind of integrate something like Uniswap that's better? And we'll basically do this kind of launchpad product, Miso, that they have, and they have this product called Bento Box, which right now has Kashi, which is like a borrow lend kind of one-click margin trading on a DEX, and can are later going to add more applications. And so they're kind of taking that more horizontal route. And I could be wrong on this, but I'm pretty sure also on the Uniswap front, they do give up like a decent amount of composability by going the NFT route. So that kind of makes it so people have to build on Uniswap specifically, and not so much just like integrate as easily as other products.
You mean by LP tokens?
Yeah.
Well, what's interesting now is that, I don't know if you know Omar from Paradigm, he's one of the EIRs there, and he's working on a protocol to take those staked assets within Uniswap and be able to earn yield on them, like very, very seamlessly. So he's working on that now. So we might see some interesting innovations in that area.
And Charlie, I think you had a pretty interesting thesis on real world assets.
Real estate is super hard. I've met a couple teams who try to securitize real estate on chain. So basically, you have like an NFT that represents ownership of a piece of real estate. But the problem is, like every time I ask them, like, how do you guarantee that this NFT actually does where is the legal guarantee that this NFT does represent this piece of real estate? They haven't solved the problem, and I don't know how to solve the problem. I'm not an expert in this area, so to me, like this is a critical missing piece. How do you tie a piece of a property and the ownership of the NFT?
Yeah.
I think it's pretty difficult unless you make, like you can do it with token, sure, but you have to make it a security, to be quite honest. Like if you're going to link the tokens legally, you basically would have to set it up as like security tokens that represent ownership in an entity, basically tokens that represent equity in an entity that owns the property, and you can distribute kind of rental income, for example, like via, stablecoins or whatever it is, but realistically, like you'd have to go through this like a real security offering process. You would only be able to raise funds from specific people that are, accredited investors, and whether or not that's like worth all of the extra friction is hard to say. Like you could probably make individual shareholders kind of ownership more liquid in a way, but they can only probably sell it on a regulated securities exchange to, another accredited investor. And none of that architecture really exists yet. And I think the less liquid a product gets, and the more like physical it is, and the harder it is to like make it divisible, the less crypto really like lends itself to that application, at least in its current state. And so with a house, it's like, well, you can't really cut it up, you can't move it, and it's really hard to sell. So it doesn't really lend itself well to the model of crypto in its like current state. And I think there's things you could do with like tokenizing it on a securities exchange that maybe are like an incremental improvement over what already exists, but the infrastructure for that just like isn't really there yet.
And there were a few startups that tried to solve for this area. I think they came out, and Proppy was one. There was a couple others that were one was backed by like Craft Ventures. Forgot the name, but they tried, and it was just ultimately regulatory is one, obviously. Second is there weren't enough buyers that wanted to go on these platforms and just purchase real estate through the internet. And so it's starting to change now a bit, but I think it's also kind of human behavior, regulations, things like that. And DeFi right now is kind of where all the mind share is. It will start to bleed over. Like one area that bled over was NFTs, and now I think it's going to start to go into other areas over time.
Let's get all of us around the horn. If I put on my venture hat and say, like, this isn't what we're seeing today, but what we could see a little ways out. So we think peer-to-peer securities trading is on the horizon, KYC in the wallets, use Chainalysis, CipherTrace, whatever, as like your surveillance overlay. So you get into that security trading dynamic. We think the equity tranche of real estate becomes very interesting, because you look at what happens with token valuations. Token valuations are much higher than what you would see for comparable equities, and it's because of two dynamics. One, you're instantly global on the fundamental side, and then two, you're instantly global on the demand side for your token. So if you think about what you would do with real estate equity, you're instantly getting this like your cap rates just asymptotically approach zero, because you're getting this like global demand. Obviously, like, there's going to be a power law dynamic where, like, you know, Chicago or New York City real estate like actually benefits from that. Other places probably don't see that big of a benefit from it. But then you get into really interesting dynamics around illiquidity and what type of like market making you see there. And we think you very quickly get into kind of AMMs, like traditional automated market makers, working off of geofence, cellular phone data, working off of foot traffic data, working off of like insurance and payments network data to constantly create bid asks for these equity tranches of commercial real estate. Like, you get into really cool stuff, but I think that's like, we're seeing a lot of emerging interest again for real estate security tokens. A lot of early stage marketplaces starting to be capitalized. But this isn't like we're getting a second wave of interest after 2018, which kind of fizzled out. And I think like probably going into 22, you're going to see some really interesting stuff. But it's probably not like this summer. It's like 6 months off.
Yeah, we're starting to see, I think there's going to be one more phase from the traditional side before we get to the Web 3.0 world. Like Carta, I don't know if you're following Carta, but now you can, not tokenize, but you could purchase and sell shares of any private company that's been venture backed. That just started, like the product just launched. So we still, I think from like a Web 3.0 world, I think we have some time because there's also like a user behavior condition, right? Like you have to get people used to purchasing shares from others online. Same thing with tokenized real estate. Like for me to purchase a real estate online it's becoming more and more open for me now, but I haven't done that yet. So I think user behavior and the infrastructure and the regulations will all kind of come hand in hand, and then there'll be a catalytic moment where it'll all just work. Oh man. I think one is like we started at the right time, right? I think when DeFi protocols were first getting to the market, the biggest, actually like when we first started investing in DeFi was like 2017. And the biggest issues back then was regulations, but then two was like users and liquidity. And so like over 2017, 18, what I used to do was just connect DeFi protocols from San Francisco to folks like Cumberland, Jump, and others, just to like build that relationship. And then I think over time, I think once DeFi summer, like right before it started, we were at like $500 million in total TV on all of DeFi. I remember this. It was just the right time for institutions to start to like have first movers advantage in terms of providing liquidity. So more of these institutions started to come in and say like, all right, we're going to start providing liquidity. And it just became kind of like a flywheel effect of startups wanting to kind of come to this program and start to connect with market makers and trading firms from a liquidity perspective, but then also from a product perspective. So we've had many teams that went through our program that actually built out a product, were in the phase of building a product because they thought that this was the right product for these users. And it turns out like institutions like, we don't need this right now. So they cut their product down, they deprecated that like strategy, and they just built out product for retail. And that's where the users are right now. And so like feedback like that, like gems and nuances like that, you can't find anywhere else, right? And so we built that into our program. We built out a way to better engage market makers, trading firms, as kind of building out your community, your product, and your regulations. And then, over time, I think like more and more protocols are just looking for like kind of a launch pad that can leverage a brand, the liquidity, the community, and things like that to grow. Chao, anything else to add to that?
I mean, I think part of it might be that we really took the ethos of crypto to our heart, which is being really collaborative. I think, like, by and large, we try to work with everybody. We try to work with all the trading firms, be it Chicago, New York, or elsewhere. We try to work with all the VCs. We try to be as inclusive as possible in terms of like bringing new projects into our accelerator, while keeping a very high standard. But I think people really like that, and we push up this network of all these different players, and they can all benefit from each other. So it's really it's really like a network effect play.
For I'll just put DeFi as a whole, and then we'll start from that. The way we tell DeFi startups, look, we're on the bleeding edge. We're building products that ultimately users will get, and this is kind of first movers advantage, and there's a risk behind that as well. And so the way we kind of guide our founders is one, you have to think about how you structure the company. Before 2017, SAFs was the big way to raise money, and it turns out it broke a whole bunch of laws, and it just really hurt founders that leveraged that funding vehicle. And now what founders are doing is they're creating very bifurcated ways of getting funded. So they're going to be typically domiciled here in the States, but then the token piece would be kind of separated from the equity piece. So they'll raise as an equity, and then there's token warrants that would ultimately convert their raise into that. So from a funding perspective, they're kind of protected. Now from a product perspective, depending on the types of products you're building, people are taking two routes. One is, or three routes. The first route is we're just not going to make the product available in the United States. That's it, right? We're just going to build for the global audience, and over time, once regulations become more clear, then we'll go that way. Two is we're going to build a product for the US. We're just going to, what I call break things, go fast, right? So that's kind of the mental model they take. And then the final is go anon. So you're seeing a lot of projects are just going pure anon right now. And that's just probably, I would probably say that's probably the best way to do it. And then over time, I mean, it is what it is. Some people are really worried about, the law and things like that. And so anon is probably another way that startups are going about it right now. So that's probably the three ways. I don't know if I've missed anything else.
There are multiple regulatory bodies that regulate different parts of crypto and DeFi. So with the SEC, I think the regulations have been pretty clear since 2017. So if you start something that touches securities or that you think might touch securities, just consult a securities lawyer. On the money laundering side, so FATF they issued a set of recommendations a couple months back, and they've been taking feedback, and it looks like a couple of weeks ago, it looked like they were going to finalize their recommendations this month, but it seems like they might be delaying it. So with FATF, by the way, FATF is this G7 financial task force that helps regulate money laundering or makes recommendations on money laundering, but it's up to the individual countries to implement those recommendations. So FATF might think that peer-to-peer non-custodial DeFi protocols are VASPs, so virtual asset service providers. So and as a result, they might have to do AML, KYC, that kind of stuff, but they haven't finalized it. So we're still in the gray area. But it seems like, thanks to the Fourth Amendment, their recommendations are not implementable in the US. It's possible that is the case in the US, but it's still possible that they might be implementable in other countries. We don't know yet. But anyway, so on the money laundering side, it's still not finalized yet. I think you want to be careful, but also know that things are not finalized. And then there's the derivative side of things, which is at CFTC. There was one. What's the word? Not chairman, but
one of the commissioners.
Yeah, one of the commissioners. They wrote a very aggressive, hostile, recommendation against crypto and DeFi. But that person he's not the chairman. He's one of the commissioners, and it seems like the current chairman is not that aggressive. At least not that we know of. But once again, with derivatives, we don't know what the CFTC really wants to do yet. And also the derivatives products in DeFi are not that big yet. But once you do get big, on the order of billions of dollars trading volume per day, it's almost certain that the CFTC is going to do something. But we don't know what it is exactly. So anyway, all that to say, much of it is in the gray area.
And the next FATF meeting is tomorrow morning at 7:30 if you want to wake up and find out what's going on.
Or just look at the markets.
Yeah. The point of stablecoins being stable, they're definitely not all built the same, right? So there's some that are backed by actual dollars from kind of what I would probably consider like highly trusted people, such as USDC. There's some that are like probably entirely backed by dollars and mostly trustworthy people like Tether that are kind of super big, but it's kind of murky, to say the least. And then there's kind of, multi-collateral assets like AUSD, which is going to be on Akala, and DAI. And then you have like algo stablecoins, which are either under collateralized or not collateralized and use like a whole bunch of financial engineering, which to my knowledge, I don't think there's been any that are massively successful or haven't been rugged at least once.
No rugging yet.
So there's like kind of a whole spectrum of it. I think what you're seeing now is kind of everything is dollar denominated stablecoins, and that's pretty likely to change over time. One of the DeFi Alliance projects that I really like is DFX,
Yes.
which is basically an AMM designed specifically for kind of FX stablecoin exchanging. And I think the interesting thing there is with the growth of like aggregators and whatnot, if you're going from like a Euro stablecoin to ETH, for example, through a DEX aggregator, assuming their product works as well as we're kind of all hoping, all of that liquidity would basically get routed through their protocol for the kind of like Euro to USDC, and then USDC pools are like the most liquid on Uniswap, so probably to there next. But there's like a whole bunch of kind of middleware products that are facilitating these things, and there's a whole range of stablecoins. So it's tough to say like what exactly happens. There's also kind of unclear regulation with stablecoins, and same thing with like clarity and kind of what's backing them. There's also like a whole range of what is like how regulatory compliant they are, right? So USDC is issued by like very regulatory compliant people or entities rather, and then there's things like DAI and other stablecoins that are completely decentralized. So it's pretty unclear how it plays out, I think.
Although I think I just saw a recent tweet the other day that I think 70% of the assets that are collateralized for DAI is actually USDC.
That is also there.
So take it as you will.
Alrighty.
Thank you
Guys so much.
Yeah, thank you all for coming.